Bill Ackman is the founder of Pershing Square, which is a hedge fund with over $18 billion in assets under management. Since 2004, Pershing Square has produced a net return of 2,400% versus the S&P's 720%. His outperformance has led to him to amass a net worth of over $9.4 billion and is now considered by many to be a legendary investor. Last year, he went on the Lex Fridman podcast, where he shared his investment strategy and how he identifies high-quality businesses. He shared a lot of golden nuggets throughout this interview. So today, I want to play the highlights, then discuss the key points afterwards so that we can all become better investors. So with that being said, let's hop right into the first clip of the interview, and then we'll discuss it afterwards.
In your lecture on the basics of finance and investing, you mentioned a book, Intelligent Investor by Benjamin Graham, as being formative in your life. What key lesson do you take away from that book that informs your own investing?
Sure. Actually, it was the first investment book I read. And as such, it was kind of the inspiration for my career and a lot of my life. So important book. Bear in mind, this is sort of after the Great Depression. People lost confidence in investing in markets, World War II. And then he writes this book. It's for like the average man. And basically he says that you have to understand the difference between price and value, right? Price is what you pay. Value is what you get. And he said the stock market is here to serve you, right? And it's a bit like the neighbor that comes by every day and makes you an offer for your house. Makes you a stupid offer, you ignore it. Makes you a great offer, you can take it. And that's the stock market. And the key is to figure out what something's worth. And you have to kind of weigh it. He talked about the difference between, he said the stock market in the short term is a voting machine. It represents speculative interests, supply and demand of people in the short term. But in the long term, the stock market's a weighing machine, much more accurate. It's going to tell you what something's worth. And so if you can divine what something's worth, then you can really take advantage of the market because it's really here to help you. And that's kind of the message of the book.
In that same way, there's a kind of difference between speculation and investing.
Yeah. Speculation is just a bit like trading crypto, right?
Strong words.
Well, short-term trading crypto. Maybe in the long run, there's intrinsic value. But it's many investors, in a bubble going into the crash, were really just pure speculators. They didn't know what things were worth. They just knew they were going up, right? That's speculation. And investing is, doing your homework, digging down, understanding a business, understanding the competitive dynamics of an industry, understanding what management's going to do, understanding what price you're going to pay. The value of anything, I would say, other than love, let's say, is the present value of the cash you can take out of it over its life. Now, some people think about love that way, but it's not the right way to think about love. But it's, so investing is about basically building a model of what this business is going to produce over its lifetime.
So how do you get to that? This idea of called value investing. How do you get to the value of a thing? Even like philosophically, value of anything really, but we can just talk about the things that are on the stock market.
Sure.
Companies.
The value of a security, the value is the present value of the cash you can take out of it over its life. So if you think about a bond, pays a 5% coupon interest rate. You get that, let's say every year or twice a year, split in half. And it's very predictable. And if it's a U.S. government bond, you're going to get it. So that's a pretty easy thing to value. A stock is an interest in a business. It's like owning a piece of a company. And a business, a profitable one, is like a bond in that it generates these coupons or these earnings or cash flow, every year. The difference with a stock and a bond is that the bond, it's a contract. You know what you're going to get as long as they don't go bankrupt and default. With a stock, you have to make predictions about the business. How many widgets are going to sell this year? How many are going to sell next year? What are their costs going to be? How much of the money that they generate do they need to reinvest in the business to keep the business going? And that's more complicated. But what we do is we try to find businesses where, with a very high degree of confidence, we know what those cash flows are going to be for a very long time. And there are very few businesses that you can have a really high degree of certainty about. And as a result, many investments are speculations because it's really very difficult to predict the future. So we what we do for a living, what I do for a living, is find those rare companies that you can kind of predict what they're going to look like over a very long period of time.
In this first clip, Bill shares that there is a difference between price and value, and this is incredibly important for investors to understand. It's also important to understand that there is a real business behind every stock, and that the stock price and the business are two different things. Your job as the investor is to figure out what the business behind the share price is worth, because if you know what the business is worth, then when its share price drops to a level below that, then you can take advantage. You also have to understand that the price of the business can become detached from the value of the business. And when this happens, again, investors can take advantage. Metastock provides one of the best recent real-world examples of this happening. In 2022, Meta's revenue dropped by $3 billion, or roughly 2%. However, its stock reacted by dropping 75% as investors thought the business was doomed. In hindsight, this was a clear overreaction by the market, which caused Meta's price to drop significantly below the business's value. And now that Meta's revenue is growing again, the stock has recovered and is now up over 600% from the lows. And again, this is a clear example of a business's price and value becoming extremely disconnected in the short term. And the investors who bought Meta as it was falling profited massively. So it's extremely important to understand that the value and price can become disconnected, and that what the price of a stock is doing is not an accurate reflection of the business's value. Ackman then goes on to talk about how to value a business, and he explains that the value of anything is how much cash you can take out of it. It's also very easy to find the value of a bond, because you're told exactly how much cash the bond will return to you. For example, today a 10-year bond is offering an annual return of 4.29%. So if you bought a 10-year government bond today, then that is exactly what you can expect it to produce for you. However, stocks are much more tricky, as it's up to the investor to estimate how much cash the business can return to you in the future. For example, here we can see that Adobe has produced $7.9 billion in free cash flow over the past year. We can also see that its market cap, or price, is $198 billion at the time of recording this video. This means that Adobe is selling for roughly 25 times cash flows, or the profits that it generates in a year. This is also equivalent to Adobe stock offering a 4% free cash flow yield. So in terms of how much cash Adobe's business can return to its investors relative to its price today, it's about 4%. This does not sound like a very high return, especially when we consider that bonds are offering a guaranteed return of 4.3%, which is actually higher than Adobe today. What this means is that investors are pricing in or paying for Adobe's future growth. This low of a yield suggests that investors are confident that Adobe's profits will grow in the future to offset the lower returns they're getting by buying the stock today. And as Adobe's profits grow, the investor's free cash flow yield will grow as well. Even Buffett has written in his annual letters to Berkshire shareholders that the value of a business is based on how much cash it can produce in the future, and buying it at a discount to those profits. Bill Ackman agrees, and he says his investment strategy is to find the rare businesses that he feels confident in predicting the future profits of. If you're interested in tracking Bill Ackman's holdings and all of the buys and sells that he is doing, then the easiest way to do that is by using the Moomoo app, which is also completely free to download, by the way. Moomoo is partnered with the NASDAQ and the Toronto Stock Exchange, and is rated #1 by TradingView users. Moomoo also has an awesome feature called Institutional Tracker, which you can find here on the markets page, and then just scroll down to the Institutional Tracker right here. Click on that, then you can search institutions, and you can actually search Pershing Square, and then Pershing Square should pop up. And then by clicking on this, you can actually follow Pershing Square as well, which by the way, again, is Bill Ackman's investment company. And when you follow it, then you can stay up to date with all of the investment moves that he is doing. Now, additionally, here we can see the value of his portfolio sitting at 12.6 billion today, the industry breakdown right here, and all of the holdings changes, which personally I find the most interesting. So as of the most recent quarter, we can see that Bill Ackman has increased his position in SEG, Nike, and if you watch my channel, then you know that I love to see Bill Ackman investing in Brookfield. Now we can also see the positions that he has been decreasing. And what's really cool is if we click on the position, then we can see that Bill Ackman has been lowering his Hilton position over the past several quarters. So he has been trimming down and lowering his allocation to Hilton, which I do think is kind of interesting. And again, you can see that very easily here on the Moomoo app. Moomoo is also the cheapest platform that I know of for trading US stocks in Canada, saving up to 90% on currency exchange fees. For example, trading $10,000 worth of Apple can save you $135 in foreign exchange fees. By using my link to join Moomoo, you can also get the following rewards: a $2,000 commission rebate card, up to $300 cash rewards, 6% APY on cash, up to $2,300 in cash coupons or Apple gift cards when you transfer an account to Moomoo. So if you're interested in checking out Moomoo, then click the link in my description. So let's now move on to the second clip where Bill Ackman discusses the kind of businesses he's looking for.
So the kind of business we're looking for is sort of the kind of business everyone should be looking for, right? A great business, it's got a long-term trajectory of growth out into the even beyond the foreseeable distance, right? Those are the kind of businesses you want to own. You want businesses that generate a lot of cash. You want businesses you can easily understand. You want businesses with these sort of huge barriers to entry where it's difficult for others to compete. You want companies that don't have to constantly raise capital. And these are some of the great businesses of the world. But people have figured out that those are the great businesses. So the problem is those companies tend to have very high stock prices, and the value is generally built into the price you have to pay for the business. So we can't earn the kind of returns we want to earn for investors by paying a really high price. Price matters a lot. You can buy the best business in the world, and if you overpay, you're not going to earn particularly attractive returns. So we get involved in cases where a great business has kind of made a big mistake, or you've a company that's kind of lost its way, but it's recoverable. And we buy from shareholders who are disappointed, who've lost confidence, selling at a low price relative to what it's worth if fixed, and then we try to be helpful in fixing the company.
In this clip, Bill explains the characteristics of businesses he looks for, which are businesses with long-term growth that generate lots of cash and are easy to understand. He calls these the truly great businesses of the world. For example, Bill owns a stake in Canadian Pacific Kansas City Railroad. CPKC arguably has the best rail network in the world, as it's the only railroad to have tracks across Canada, the United States, and Mexico. Railroads are considered the backbone of the economy, and they are the most efficient way to move goods long distances. Trains are significantly more fuel efficient than trucks, and they keep the transportation of goods off of our roadways, which allows the road infrastructure that we have to be much less congested. Since CP's rail network expands across all of North America, it gives it a huge competitive advantage and will most likely allow this business to continue producing profits for decades, if not centuries to come. Basically, as long as goods need to be moved across the economy, then CP will produce cash. It's really that simple. Bill then says that the price we pay for our businesses is extremely important, and I agree. He then says that you can buy the best businesses in the world, but if you overpay for them, then you can still end up seeing lower returns. My favorite example of this is Microsoft during the tech bubble. From 1996 to 1999, Microsoft stock ran over 1,000%. This caused its price to free cash flow to hit a high of 52, which is a very high price to pay for any business. From its peak in 1999, the stock fell for more than a decade and produced negative returns. It actually took 16 years for Microsoft's stock to hit a new high. But what's interesting is that Microsoft's underlying business continued to grow significantly from 1999 to 2016. Its revenues nearly 5x'd, and so did its profits. Yet despite all of this growth, the stock still produced negative returns, as the investors in 1999 were pricing the business way too high, and therefore they were paying for a significant amount of the business's future growth. Today, I feel like price is something the market is starting to disregard once again, as I have been seeing dozens of people say that you need to buy high quality businesses and forget about the price that you're paying. But I think that this is a huge mistake, as price is very important, and Bill Ackman seems to agree. Alright, now let's head over to the next and final clip where Bill discusses how he researches stocks.
What's the actual process you go through? Like, literally, like the process of figuring out what the value of a company is. Like, how do you do the research?
Mhm.
Is it reading documents? Is it talking to people? How do you do it?
It's all of the above. So Chipotle, what attracted us initially is the stock price dropped by about 50%. Great company, great concept. Athletes love it, consumers love it. Healthy, sustainable, fresh food made in front of your eyes. And great. Steve Ells, the founder, did an amazing job. But ultimately, the company's lacking some of the systems and had a food safety issue. Consumers got sick, almost killed the brand. But the reality of the fast food quick service industry is almost every fast food company has had a food safety issue over time, and the vast majority have survived. And we said, look, such a great concept, but their approach was far from ideal. But we start with usually reading the SEC filings. So companies file a 10K or an annual report. They file these quarterly reports called 10Qs. They have a proxy statement which describes kind of the governance, the board structure. Conference call transcripts are publicly available. It's kind of very helpful to go back 5 years and kind of learn the story. Here's how management describes their business. Here's what they say they're going to do. Then you can follow along to see what they do. It's like a historical record of how competent and truthful they are. It's a very useful device. And then, of course, looking at competitors and thinking about what could dislodge this company. And then we'll talk to, if it's an industry we don't know well, we know the restaurant industry really well, music industry, we'll talk to people in the industry. We'll try to understand, the difference between publishing and recorded music. We'll look at the competitors. We'll read books. I read a book about the music industry, or a couple books about the industry. So it's a bit like a big research project. And there are these so-called expert networks now, and you can get pretty much anyone on the phone, and they'll talk to you about an aspect of the industry that you don't understand, want to learn more about. Try to get a sense. Public filings of companies generally give you a lot of information, but not everything you want to know. And you can learn more by talking to experts about some of the industry dynamics, the personalities. You want to get a sense of management. I like watching, podcasts. If a CEO were to do a podcast or a YouTube interview, you get a sense of the people.
In this clip, Bill says that he becomes interested in stocks when their prices fall and when short-term negative events are affecting a high-quality business. His example was back from 2016, when Chipotle stock fell 50% due to a food safety issue. He then says that nearly every fast food chain will have this happen to them at some point, and they always get through it. Therefore, this was a short-term event that caused the stock price to fall. But Bill believed that over the long term, Chipotle would continue to grow its profits and succeed. And as a result, he used the 50% drop in the share price to buy a large stake in the business. Since Bill's initial buy, Chipotle stock is up over 600% now, and he has made over $1 billion on this investment. He also says that he reads SEC filings of businesses and listens to their conference calls. Conference calls are an incredible source of information when you're analyzing a business. You get to hear the management answer questions from investors and analysts and how they're thinking about the business and its future. You can also go back and read the historical transcripts of a business. So you can go back 5 years, look at what the management said they were going to do, and then see if they missed, met, or exceeded their targets. You can also see if they have a history of meeting their expectations or if they have a history of missing them. And then that can give you additional confidence in the future projections of the management today. You want to get a sense of the management, their integrity, and if they can be trusted with your money going forward. For example, when I was initially researching GoEasy stock, I went back through all of the company's historical projections, then compared them with how the business ended up performing. I found that GoEasy consistently outperformed their projections, and to this day, they're continuing to do so. This showed me that the management likes to underpromise and overdeliver. So now when I am viewing GoEasy's current projections, I know that the management has a long track record of beating them. This gives me faith that the company can continue to hit and beat its projections that it's setting out to this day. Bill says that you also want to think about how easily the business can be disrupted by competitors. For example, Warren Buffett once explained that if you had $30 billion to try and overtake Coca-Cola, you wouldn't be able to do it. So if a new business wants to come in and try to overthrow Coke, they would have to go and spend tens, if not hundreds of billions of dollars just to try. It would cost an enormous amount of money just to make a dent to Coke's business, and therefore, Coke's business is not one that you can easily disrupt. GoPro, on the other hand, is a great example of a business that was easy to disrupt, and ultimately it had no moat. GoPro was famous for being the first wearable action cam, and in 2014, its revenues were exploding. However, when the market saw how successful GoPro was, competitors started to copy their product and take some of the market share for themselves. As a result of this increased competition, GoPro's revenues have been declining since 2015, and they continue to fall to this day. At the end of the day, the company created small cameras, which was very easy for competitors to replicate and sell for a cheaper price. This is a clear example of a business that was easy to disrupt and had no real long-term competitive advantage. So it's incredibly important to be thinking about the durability of a business, what makes it successful, and how easy it is for competitors to replicate this success. These questions will help you identify if the business has a moat and how durable that moat is. But with that being said, that is going to wrap up the video for today. So if you enjoyed this video and you would like to see more content like this, then please leave a like on the video and let me know down in the comment section below. Also, if you're new here and you want to stick around and see more stock market related content like this, then please consider subscribing to my channel, and also make sure to check out Moomoo using the link below if you want to get all of those benefits that we discussed earlier. But with all that being said, as always, thank you guys so much for tuning in. I truly do appreciate it, and I really hope to see you all again in my next video.